the Swiss cooperation, which has supported the visit in the form of the bilateral cooperation for central banks. I'll be happy to take questions as we go, so please do make questions. And I should stress that this is a relatively new project, so it's still a work in progress, as you'll see in a second. And therefore, it's a great moment to make questions and to provide comments. It's a joint project with the Refet Gu and Mahmut I from Bilkent University. And just to get started, as we know by now, China matters. And matters in many ways, of course. It's a huge country, it's a huge economy, and it's a growing economy. But also it's a center for innovation at the moment, not just in terms of technological innovation, but also policy. And that's the reason why it has been and is important to think about policy making in China. And that's what we try to do in this paper. Now, just to remind ourselves a few kind of numbers, China is the largest manufacturer in the world, so it's a huge production center, and is the second trade partner for the Euro area, and the third for the US. And as an economy, is projected to be the largest economy in the world by mid-2030s, which is not a long way ahead of us. Also, it is, in terms of policy making, a very unique country, because differently from the more familiar cases of the US, Euro area, the advanced economies, they use a very sort of unique set of tools and a different probably thinking behind them. And there's in fact a very unique monetary policy, but also uniquely importantly, because of course the global impact that this policy can have on the rest of the world. Now, when we think about monetary policy, we usually use tools that have been developed for the US and in part for the Euro area. And these tools generally cannot be applied straightforwardly to China, even if we would like to do so. Now, in fact, when you think about studying the effects of monetary policy in China, of course, monetary policy in China is a big topic on which perhaps is not enough research yet, even though there's a growing research on monetary policy. But when we think about applying the tools we have normally for analyzing monetary policy effects to China, there are 5 at least key challenges. First of all, the monetary policy of China has been changing over time, has been evolving over time. When we think of monetary policy in China, usually we think of a country that does monetary policy having in mind multiple policy objectives. Very often we think about a growth target for monetary policy, but also there are specific targets in terms of the industries that China wants to develop, and therefore there's target lending. And these multiple policy objectives have been changing over time as well, which creates a difficult problem as a baseline. When we think then in terms of the policy instruments that are used to implement these policy objectives, we also know that China uses a very large number of different rates in different forms, and they're used to target potentially different concerns. Sometimes real estate, sometimes stock market, sometimes other sort of types of concerns and objectives. And in fact, there's no sort of intermediate operational target that we can easily understand for China, as it will be the Federal funds rate, the intermarket bank rate for the US, where we know that that is the operational target that interest rate will try to stir. And there's no similar markets as the Federal funds future, which is often used in the case of the United States to study then the transmission of monetary policy to rates and then to the general economy. On top of that, when China and the People's Bank of China makes statements, makes announcements, often these announcements are made when markets are closed. More than half, if I remember correctly, of the decisions were announced at market close, and that is probably a deliberate decisions in order not to move market too much. All of these challenges point to how difficult it is to tackle this problem. Time variation, multiple instruments, multiple goals, and no kind of markets we can use in a standard way to assess the impact of decisions. And underlying these challenges, there's the need and the sort of the problem of defining a summary measure of monetary policy. When you think about the transmission of monetary policy, for example, for the US or for the euro area, usually we think of changes to rates, perhaps the policy rates, the short-term interest rates, and maybe for a guidance or QE kind of interventions, and how they transmit to interest rates in the economy, to the bond market. And we use these sort of summary measures to then think about the transmission to the rest of the economy, to the domestic economy, and then eventually perhaps to spillover, international spillover effects. So that's the problem, and that's the problem we try to tackle in a bit of a creative manner with this paper. Of course, there's some that has been done, and there's a list of papers, which is not extremely long when we think about the study of the transmission of monetary policy in China and connected problems. And in fact is, let's say, short enough to put it almost on one slide. And when you look at what has been done, generally there are two things. There are two broad approaches. One is the dominant one, I would say, the more popular one, and comes from a paper of Chan, Ren, and Jia on 2018. And in this paper, they try to understand the effects of monetary policy of China, and they look at M2 growth as essentially a measure of the stance of monetary policy once you control for a bunch of variables to which the central banks might decide to adjust the stock of money. So effectively, it's a regression approach in which you regress M2 growth onto a bunch of controls, trying to separate an endogenous component from an exogenous component, and then you zoom in onto the exogenous component. You try to use that as an IV for changes to monetary policy. And a similar approach has been used in a very influential paper of no, not at all. Of Silvia Miranda Gruppino, Nenova, and Helen Ray in 2025, where they essentially take the same approach and they refine it, adding, for example, nonlinear controls to account for the potential nonlinearities in the movements of M2. So that's one approach, which is very influential and provides us with some results. And then there's been an attempt, or several attempts, to bring in more kind of state-of-the-art approaches, which would use market prices, asset prices, and would look at how these asset prices are changed by announcements. And generally, and there are several of these papers. And when you look at these papers, they look at different sort of measure of interest rates. For example, rates on non-negotiable certificate or negotiable certificates of deposits, or they use different measure of interest rates. And when they do that, what they have to do is to look generally to daily changes of these prices around the announcement between the closing on the market on one day and the opening on the next day. Because as I was mentioning before, many announcements are done when markets are closed. So there's no way to control for intraday movements as we would do in advanced economy settings. And then, of course, there are other studies that look at some of the specificity of the managing of the exchange rates with the China parallel currencies. This is, for example, the very nice paper by Zhai and Rice. Or they look at the spillovers from Chinese macro news, not monetary policy. So this is more or less where we stand. And I would say probably the dominant approach, also because provides us with more robust results, is to look at M2 and try to separate endogenous and exogenous movements in M2. Now, this is, of course, is a very smart approach, is a very intelligent approach, trying to essentially to build up from scratch some sort of endogenous reaction function of the Central Bank of China to conditions in the Chinese economy. However, potentially has shortcomings. And for example, here I'm taking a quote from one of the speeches of the Governor Yi Yang in 2018, where he was remarking that the correlation between M2 and the real economy has been decreasing over time. And it is forecast to be decreasing even more because effectively the economy has become more and more market-oriented. So there's a more emphasis on rates and different sorts of approaches to the managing of monetary policy. And on top of that, there are different sort of interest rate indicators that the central bank will look at, and different interest rates the central bank will use in order to control the economy, to stabilize the economy. Now, the underlying big problem here is that this is essentially a multi-instrument, a multi-goal framework. And when you think of that, it's quite obvious that it cannot be summarized by a single rate or a single measure. So what this paper asks in a kind of tentative way is whether that's true or instead this can be done and how it can be done. Now, just let me give you a little bit of a summary of how Chinese monetary policy is unique and how it differs from things that we know perhaps in a more detailed manner, as for example, monetary policy in the euro area or in the US or in another advanced economy. When you look at high-level objectives, and this is a table I'm taking from the paper of Dust and Song, 2023, usually advanced central banks have a single mandate stabilizing inflation, or perhaps a dual mandate stabilizing output gap and inflation, unemployment and inflation, or sometimes it can be a triple mandate. But usually it's a well-defined mandate. The People's Bank of China instead has multiple objectives in terms of price stability, an economic growth target, which is shared with the broad government, employment growth, maintaining the balance of payments in a stance which is considered compatible with the long-term goals of the economy, but also potentially financial reforms, opening up the market, developing financial markets, so as a very broad range of objectives. And in terms of the intermediate targets, generally advanced economies will look at inflation. That is going to be sort of the focus of the intermediate managing of the economy, while the Central Bank of China, again, can look at exchange rates, credit to specific sectors, what is called total social financing, which is again a measure of the direction towards some of the sectors in the economy, and to growth, inflation. So clearly, when you look at the statements and the discussions that are provided by the Central Bank of China, there's a more complex and more nuanced, if you want, set of targets. And that is reflected in the operational targets. Generally, advanced economies, central banks in advanced economies use the overnight rate interbank market rate as the operational target, the rate that central banks try to stir, while in the case of the People's Bank of China, there's the monetary base, 7-day interbank repo rate, loan prime rates, and so on and so forth. Reserve over asset purchases, and again, a very complex setting. And in terms of primary instruments, generally central banks in advanced economies use open market operations, and they use often a corridor system and sometimes a floor system. If you compare that with the instruments of the Central Bank of China, well, that's a lot more nuanced, sophisticated, complex picture, because you have 7-day repo rates with a corridor system, open market operations, benchmark rates, lending facility rates of different types, required reserve ratios, which are moved as well in order to achieve policy objectives, administer rates, and so on and so forth. So very complex picture here. Now, if you want to look at how things have been changing a bit and the dynamics of these things, these are some of the rates. There is the loan rate that is at the top. You have a reserve repo rate, which forms now some sort of a bottom of a corridor. You have the Shibor rate, which is the interbank rate on the Shanghai market. You have the medium-term lending facility, this MLF. And as you can see, they've been changing in terms of appearing or disappearing on the chart. That's kind of the time varying nature of these things, the evolution of the framework and the thinking. And there are more than one, of course, and sometimes they don't even move in a synchronous manner. And they also don't move in a synchronous manner with the reserve requirement ratio. And perhaps if you can help me with clicking 1 second to give you a broad picture, you see also the kind of movements of these things, and the decline is not kind of moving in a synchronous way with the rates. So obviously, these movements respond to different needs of the bank and different sort of short-term, medium-term, or long-term goals. And perhaps if we can, thanks. Okay. Yeah, please, thank you. And here I'm also plotting the bands. These are recession bands or cyclical bands that are provided by the San Francisco Fed. So, and you see there is cyclicality in these things, as you would expect. So the question is, what can be done? What can we do? And is there a way to summarize all of these instruments in one measure? Now, as I was mentioning before, high-frequency identification, or using high-frequency interest rates to identify a measure of, let's say, exogenous changes in monetary policy for China is difficult. However, the intuition we have, and that drives this paper, is that in the end, even if there are a lot of different measures, what really matters from the point of view of monetary policy as a way to affect the economy by changing demands is the overall effects on demand for internal demand. So if you think about the central bank, they use different instruments for different goals. For the aggregate economy, at business cycle frequency, what really matters is the overall effects of the different changes on internal demand and how that then reflects onto the dynamics of the economy. So the idea is then to find something, let's say some asset, that might capture this change in demand that is due to monetary policy in China, and potentially that is able, at the frequency of the decisions, at high frequency, to capture the unexpected component of that policy, of the change in demand. And in order to do that, the idea is to look at the role of China in commodity markets, because China is an enormous buyer of commodity, as well as an enormous impact on commodity markets. And if we can find, in a way, some commodity price or many commodity prices that can respond quite fastly to changes in demand from China, and therefore they would respond to announcement of monetary policy in China. And if these objects, this asset is able to summarize in a good way these changes, then perhaps we can use that in order to measure the unexpected component of monetary policy in China and to measure the transmission of monetary policy in China. And the underlying mechanism we have in mind is very simple. You change monetary policy in China overall. You can change many instruments at the same time. But in the end, if you're tightening the overall bundle, then you would expect weaker domestic demand. This weaker domestic demand should reflect in weaker production dynamics and investment, and will give a signal lower demand for industrial inputs, and that will put downward pressure on global commodity prices. Now, if we have some financial markets which are liquid enough and forward-looking, they would go through this chain and reflect that quite instantaneously on the commodity prices. So that's the hope, and that's what we thought of doing. So in the end, this becomes a search about one asset, one magic asset, which has to be sensitive to the broad Chinese monetary policy stance, that is fairly sensitive, but with stable sensitivity to Chinese demand, with a market price, cannot be an administered price, has to be traded when China announces its monetary policy and when Chinese markets are closed, and has to be liquid enough so that its price change will reflect immediately the change in stance. Now, we went through different tests and different ideas, and we stumbled upon copper, and copper seems to work well. Now, why is it? Well, there's quite an obvious reason, which everyone on the markets of commodities knows, and that's why copper is called Dr. Copper by analysts in the copper market. But this is a list of commodities we explored: nickel, steel and coal, crude oil, aluminum, zinc, and finally copper. And when you go through this list, what do you observe? What we observed was that effectively copper was the good candidate, because nickel probably is not such a deep market and has a lot of price volatility and was subject to a lot of market disruption. Steel and coal do not have intraday trading data, which are important for us to capture the exact moment of the announcement. China does not really import a lot of crude oil. Aluminum and lead do not have a stable absorption from China over the period of interest. And zinc could have worked, but doesn't. And probably for the same reason, nickel does not work in the same way. Probably is a market where supply shocks are fairly important, so there's volatility that does not allow us to then extract the signal about Chinese demand. So in the end, we end up focusing on copper, that in particular the future market of copper, for which China has a huge share. I will show you in a second the share of China. And we look at forward contracts on 3 months rolling forward contracts on the London Metal Exchange. That's very important, actually. Iron ore. I don't think there's an intraday market. But
yeah, still it's definitely we do not have intraday, but for iron ore, I wouldn't.
I will double check. Yes, let me take a note. Thanks. And okay, let me show you the share of China, the role of China, the impact of China in this market. And it's a very large one, and it's fairly stable. So it's kind of increased slowly from 40% in 2012, was slightly less at the beginning of our sample, which is going to be 2007. But most of the exercises I will show you are starting from 2012 for a reason that I will have to explain, and then kind of increased up to 50%. So it's a huge share of this market. And doesn't show a lot of kind of variation in the sample, which is great. It's exactly what we want. In terms of contracts, we look at future contracts on the London Metal Exchange. These are very liquid markets for commodities, so they're very deep. They are very reactive to news, any sort of news. And the good thing is that when you look at the London Metal Exchange trading hours between 1 a.m. and 7 p.m., and you overlay that with the announcement of Chinese monetary policy, this is an histogram of the number of the announcement happening at different hours, and you compare the hours where the Chinese market is closed with when actually the market in London is open, you see that essentially you're capturing most of the announcement. There will be few exceptions that I can show you later, but effectively the market is always open when the announcement, apart from Sundays, when sometimes announcements are made, or a bank holiday for the UK. So that's a good sort of lucky coincidence that somehow when Chinese markets are closed on the other side of the globe in London, the metal exchange is working and is ready to absorb the news and to process it into the price of copper. And these are the types of announcements you have, and you see now the heterogeneity of the announcement. Very different sort of types of the announcement. Sometimes are liquidity injections, sometimes is the loan prime rate, sometimes is rediscount rate, sometimes is required reserve ratio. And as you can see, the mix is changing. And that is really an image of how much monetary policy has been evolving in China. So there are these two broad observations. First of all, there's a bit of an increase in announcement. So monetary policy appears to be more active in, I would say, the second part of the sample. There's a change in the mix of the instruments, with some instruments that are more prevalent in the second part. That was also visible in the types of rates that were used. And also the complexity of this announcement, where often in one single announcement, different sort of policy tools are changed. Quite fascinating. Now, let me show you some events. This is an event on 21st of November 2014. The reading from Bloomberg tells us that China cut the benchmark interest rate for the first time since 2012, and that was sending the global shares of oil metal prices higher. And in fact, that's the moment of the announcement. This is the copper future, and you see that immediately the market reacts with a sharp adjustment. So kind of factors in the change in demand from China. Copper goes up a lot, which is a good sort of test. We plot many of these events, and generally we see that there's a very sharp response to these markets. And this is another event on the 3 February 2017. There is a monetary policy announcement, and the Reuters reads an unexpected Chinese interest rate rise. That sounds like a monetary policy shock to me. So there's a tightening, and you see that copper starts sliding quite immediately. It's not as sharp on impact as before. Markets take a couple of minutes to think about what's going on, and then there's an adjustment. Okay, so that's all encouraging. This was a change in the 7-day reverse repo rate. The one before was a loan rate. It was changed. So different instruments, they all kind of get summarized by copper, which is what we would hope to find. This is another announcement. This is the reserve requirement ratio. Completely different instruments gets lowered. So it's cut for the first time. This is a UOB group in a move more than a year. And the broad-based cut was more aggressive than expected. Again, that signal is surprise on the markets, including themselves, the analysts. And also came sooner than expected. So also the timing, not just the scale, was unexpected. So that will be an easing in broad terms. And you see that the copper price goes up. Fantastic. So what this will tell us is that, you know, different tools get summarized quickly in the market and get summarized in the right way, because clearly the lineup of the type of actions and the type of unexpected action particularly lines up with movement of copper, increase in demand with decrease in demand. Now, these are the total events we have. We have a total of 270 events distributed in 265 days. Sometimes you have multiple events in the same day to make things easier. There are no intraday data for only 2 days. Markets were, for some reason, not operating. We're not sure what was happening. 12 happened in weekends when the London stock market is closed, 6 in bank holidays. And then effectively we end up with 249 events, which is a good measure. So we're happy about that. We have a table with all the missing events, explaining why we miss some days, and that's effectively bank holidays and Sundays. Okay, that's, you know, Sunday is really when the central bank want to be naughty and no one can check the markets. These are the intraday copper returns around monetary policy announcements. So that's
Sunday. There are some. It's often common that people check also like on open, on close, the difference, and sometimes it's in case of US, sometimes the difference is quite huge.
Yeah, so that's
the reaction.
Right. So that's effectively what people have been trying to do for China. So there are some papers, as it was that there was listing in the literature slide, and people were looking at opening minus closing. The problem with that is that a lot can happen in the night, and also there's around opening and closing, there's a lot of behavior that depends really on the trading behavior rather than just the news. And you would like not to confound those things. And also, of course, being intradaily gives you a more precise measures, and it has more cost in the end because we're not losing a huge number of events. So we think it's a sacrifice worth making. Okay, so these are the series, and again, you see it, somehow there's more activity towards this part of the sample. There's more sparse activity before that signal the change effectively. And it's a fairly, if you look at the time series, looks fairly like white noise. Maybe there's a bit of heteroscedasticity in terms of the bundling of sort of volatility, but looks like mean zero, a good sort of white noise object. And also, if you remember the interest rates, they were kind of sliding overall, and also the reserve requirements were on a downward trend. So there's been overall an easing. But you don't see that here because it's fairly mean zero. And that means that sometimes markets are surprised on one side and sometimes on the other side compared to what they were expecting, which is a good sign of a measure of surprise from markets. You wouldn't want to see that they're always surprised on one side because that.
Can I ask a question about the
Please.
copper price dynamics? Like in the previous slides, in those events that you've shown, you always had sort of like a decrease in on the graphs. Yes, you always have a sort of anticipation decrease in price before the announcement, and then you have a jump. Like even on the previous examples.
Like here.
Yeah, like here.
So you mean it's going down? Right. Could depends
And
on.
even before that, on the previous one as well.
Yeah.
You also have like it was fairly stable until like 1730. Then it started to anticipate that in an hour there's going to be an announcement, and then there is a jump.
Yeah.
So it might have like sort of increased effect just because markets were anticipating, but why? Like they anticipate. Like it's that's why it's a good question. Why
No, I think probably it's just a small sample bias in the sense that these are three charts, and this is just the market dynamics. Could be there is some news, some leakage, something, but I think generally they don't announce the announcement, so we don't know there will be an announcement at a given hour. They just come to the market and announce it. So I don't think there can be a lot of anticipation, but perhaps there's some leak in a way. I cannot. I don't know. That's the honest answer. Okay, so these are the. So again, an histogram of the surprise, and you see it's surprisingly well behaved, around 0 with a nice distribution, a bit of fat tail. Looks like a series of surprises, effectively, and they are all sign reversed, I should say, in order to match the tightening with an increase and an easing with the decrease. So they look more like monetary policy shocks instead of sign reverse demand things. Okay, this is a mistake. Fine. Let me start showing you the first empirical results with some asset prices responses. This is almost a sanity check for these things. So what we do, we look at interest rate swaps, SHIBOR rates, government bond yields, and then I show you some stock market indices and how they react to this surprise announcement. For now, let's think of them just as a surprise announcement. It's a news hitting the market, perhaps not yet an identified monetary policy shock. So that's the response of the SHIBOR rates at different maturities. So it's a yield curve, effectively, from 3 months to 5 years. You have the SHIBOR here, and you have, I don't know if there are questions online in case, okay. And these are swaps. And you see that this is essentially a tightening, and you have an increase of the rates. As you would expect, is a significant increase in rates, good sign to start with. And then we can look at a longer maturity set by looking at Chinese government bond yields. And for Chinese government bonds, there are two markets. There's an interbank market, the internal market, and there's an external market. That's why we have two set of points here. The blue ones are the internal markets, domestic market of bonds, and this is the foreign markets, which I think is traded in not sure, Hong Kong. And they line up nicely, and you see that there's a tightening. So there's a surprise increase in it's surprise tightening in the stance that is reflected in the rates. So think about you change reserve requirements, that affects interest rate, and you see that in the bond market. With a little bit of a hump shape response. So there's some expectation of the duration of the change. And then on longer maturities, less affected as it should be. So that's the good news. And then you can look at the effects across markets. First in Asia, Japan, Korea, India, Malaysia, Indonesia, Singapore, Hong Kong, China, and Taiwan. And you see there's all across the board a significant downward repricing of stock markets. With, of course, a larger repricing in Hong Kong and China, and a smaller repricement across the rest of Asia. That's a sign of effectively the importance of Chinese demand for the rest of Asia. And you can also have a look at other economies, US, Canada, Mexico, Brazil, Chile, the Euro area, UK, Australia. You see there's a similar pattern of responses. A little puzzle is here, Chile, because Chile is an exporter of copper. Now, it turns out that the stock market of Chile does not have copper exporters, so it's not really sensitive to copper itself. It's a little idiosyncrasies we discovered in Chile, 1% in Chile. So again, sanity check, fairly in line with what you would expect. Now, the next step is to think about building up an IV for monetary policy shocks, which is essentially you have to think a little bit more carefully about these monetary policy surprises. And so what we want to do is to take our high frequency surprises that are measured using these high frequency intraday changes. I'll show you more in details what we do now to construct these high frequency surprises. And then you might want to think about orthogonalizing these surprises, perhaps to control for information effects or for delayed sort of response to information. And in doing that, we use a regression approach similar to what Bauer and Swanson have proposed. So essentially, we take the surprises and we regress them on lagged domestic stock market returns to check whether there's a predictable component, effectively. And then we also construct essentially macro models, Bayesian VRs with a bunch of variables for China to study the domestic effects. And we add to this system one kind of monetary policy indicator monthly frequency, which is just the first principal components of multiple policy rates and money market instruments. It's a bit of a summary of all the rates in the economy. All of what I was saying before about multiple instruments, different sort of things, should caution us about using this as a good indicator necessarily. But perhaps we can look at how it moves as a summary measure of the rates. So that's what we want to do. And in terms of the construction of the high frequency surprises, what we do, we look at the announcement at the time t when it was reported on the terminals. We take 5 minutes before that, 20 minutes after that, so we have effectively a 30 minutes window. And to avoid market noise, we take 10 minutes post-event windows where we average the price, and 5 minutes pre-event window where we average the price to remove the volatility in the markets, and we take the difference between these 2 points. Multiply by 100, that is the measure of surprise. This is a scatter plot of changes in the stock market index daily and changes in the 3-month copper futures at high frequency. And what you would expect is somehow a negative correlation once you flip the sign. These are flipped sign, so think of them as monetary policy surprises. So you would expect a negative correlation between the stock market in China daily frequency and the surprises. And effectively, you observe quite a bit of mass here, but also some mass off diagonal, which would point to something that looks like information effects. Now, in the case of China, there's a big debate on information effects. In the case of China, it's likely that the Central Bank of China has private information, because there's a big sort of doubt about officially produced statistics. The Bank of China has a lot of private information potentially from the financial sector, from productive sector, from the regions, which gets aggregated, and therefore it's likely that that financial markets try and get information about the state of the economy, and not just try to extract the news, the surprise, the exogenous component of monetary policy. We don't know how to control for this yet. We have an idea, and the idea we have is to use the differential responses of importers, of pure exporters versus domestic producers, because one would be only sensitive to domestic demand, the other, if it's a pure exporter, would only be sensitive to interest rate changes, and see whether we can control for that. But that's a work in progress part. So there will be some price puzzles I'll show you, and we're thinking about how to deal with that. It's a fascinating open question. Okay, so we remove the predictable component I was telling you before, and then we compose this policy indicator, this sort of summary measure for rates, by putting together the 1-year loan prime rate, required reserve ratio, rediscount rate, 1-year SHIBOR, 3-year deposit rate, 5-year interest rates, bond rates, Now we have removed in some robustness thing, the required reserve ratio, which is not the rate, and things are more or less similar. And then we use IB identification, external IB identification, to identify monetary policy shocks. I need to speed up a bit. So I want to show you the results. The baseline is going to be 2012 to 2024, so we exclude 2008 because there appear to be stronger information effects. Was also kind of a slightly different country, but I'll show you the results. So we have in this baseline 192 events. I'll show you the longer baseline thing from 2008. And then we also do some robustness with COVID, which I'll probably have not time to show you. So first of all, effects on the yield curve. This is a Bayesian VR with monthly data, where the monetary policy shock is identified with these projected monetary policy surprises projected on the past market data. And this is the yield curve of the interbank market rate. You see that this is the indicator. The Chinese monetary stance is our principal component of different rates. Goes up. We normalize the response to 1. And you see that there is this nice sort of yield curve response from the 1-year rate that moves more than the 5-year, that moves more than the 7-year, that moves more 10-year, and 20. So there's this kind of nice shape of responses across maturity. So it looks like monetary policy in a sense. You can also look at the exchange market, the external market, similar response. So these are the same variables I was showing you at daily frequency before. This domestic and exchange market for Treasury of China, similar pattern of responses. And then I want to create a domestic macro VR, not with rates, but with macro variables at monthly frequency. And we use a bunch of data, most of which are not produced by the Chinese Statistical Office. And the reason is that there are doubts about the quality of some of these indicators. So you might want to use measures of industrial production, CPI, that are checked or produced or filtered or kind of assessed by experts and by market analysts. And that's what we do. And these are the responses. So this will be the response to an exogenous tightening of monetary policy identified using copper prices. So first of all, this is the indicator, this principal component of interest rate goes up, as you would expect, significantly, and then declines towards equilibrium, let's say. And in response to that, there is a contraction of Chinese monetary of industrial production, and there's a contraction on impact of Chinese prices that stay below level for a long time, and the contraction is around 6%. This is an indicator of investment produced by private analysts, and the Chinese stock market also contracts. Okay, this is a full sample from 2007, so the full length of what we have. Now you can see there is a bit of a output puzzle, a bit non-significant, and the shape is slightly different. Same for Chinese CPI, a bit of a puzzle, and then they start declining. So clearly there is some information, something we need control for. The direction is good, so it's not like we're looking at something that's completely different, but it points to the need of cleaning our instrument and understanding better the structure of these surprises in the 2008-2012 period. Okay, let me, in the interest of time, because I have a bit more than 5 minutes, summarize domestic findings, the preliminary domestic findings, I would say. And the summary is that the AV works. So this AV, and that was a bit of a leap of faith for us, that we take from the copper market and London Metal Exchange, seems to correctly capture changes in monetary policy stance from China, and to give a decent summary, because we observe this coherent movement of market variable at daily frequency and macro variables at monthly frequency, in line with what we would like to see from monetary policy. The second sort of preliminary conclusion is that monetary policy in China effectively works as in the rest of the world. So tightening corresponds to downward pressure on prices and contraction effects on output. And the contemporaneous effects are fairly large. So there are these kind of jumps in prices. Now let me move to the second part of the macro effects, where we look at international spillovers. And again, this is a bit of a tentative set of results, which might shift over time if we keep sort of cleaning and improving our understanding of the relationship between the copper market and the different sort of ways in which the Chinese authorities shape the markets. And in order to do that, I will look at the euro area and US using standard set of macroeconomic variables for US and the euro area. And I will use a bivariate VRs, which have Chinese variables and euro area, or Chinese and US. And I will show you the results from one economic area or the other, condition on exogenous increase in a tightening of monetary policy as captured by our cleaned up or partially cleaned up instrument. Let me start from the euro area. Tightening in China. Following the tightening, there is a contraction of prices in China, but also in the euro area. Part of that could relate to the response of commodity prices as a whole. So there's a contraction of demand from China, there's a contraction of overall demand in the world, and that has a disinflationary effects. And part of that could be demands from China for European goods, and that creates a downward pressure on the HICP inflation. You see the response of euro area import prices, they go down. So there's a spillover from internal prices to import prices for the euro area. That also has an effect potentially on the HICP inflation for the euro area. But when you look at the real variables and the labor market, euro area GDP and euro area unemployment, the effects are non-significantly, especially for the GDP, they're non-significantly for unemployment at 90%, and there's a bit of a slow decline, which indicated there's not a real large effect of demand from China for euro area, how probably you would expect. For United States, a similar picture. Again, is a tightening in China that is kind of reflected in contraction of prices of China as before. There is a reduction in commodity prices globally, as we saw before, and US CPI contracts, and also there's a decline in US import prices. Both euro area and US are heavily importers, are big importers of Chinese goods. Not much of an effect on GDP for the US, nor US unemployment, so not large spillovers on the real side of the economy or the labor market. Okay, I need to conclude. Let me summarize these preliminary results. Again, they might change. It might be that once we refine the instruments, we're going to find larger real effects. I cannot guarantee on that. But overall, it seems that the tightening in China has an effect on inflation for US and euro area. And there's a bit of a question mark on output effects, which are negligible given what we have so far. Let me conclude, because I think I'm 1 minute from being out of time. Chinese monetary policy is important, increasingly important for the global economy. What we do here is to try and find a way to measure monetary policy surprise changes in China at high frequency. And in order to do that, we cannot use Chinese markets. We have to use a different market, a different asset, which in our case is copper. And once we do that and we look at surprises in the copper market, then we find that we can apparently correctly identify surprise monetary policy changes in China. And that indicates that Chinese monetary policy internally works in conventional manners, has spillover effects on prices across the globe, and affects financial markets across the globe, which is also big sort of effects we find. Now, there's a lot to be done here. First of all, we want to think about this information channel. We have this idea of looking at differential responses for firms producing only on the internal market and firms producing only for the external markets. We have some preliminary results. We need to polish them. There's some understanding to be done on the COVID period. We need to improve our estimation approach. We need to put priors of COVID, all of that, that's to be done. There is a better work to be done on spillovers to make sure that we correctly gauge these spillover effects, especially on the real side. And we need to assess the effects on emerging markets, other emerging markets, not just on the two main advanced economies. And there's a bit of a almost a philosophical problem here, in the sense that when we think about monetary policy for advanced economies, usually we think of that in isolation from fiscal. Now, the question is, in a system as China, where policies are more organic, one could say, whether the change in monetary policy is effectively an announcement about a coordinated change in the two sides of the government, fiscal and monetary, and therefore by only measuring one, we might be kind of misattributing or misunderstanding the full policy mix that is underlying that announcement. And that's a bit of a philosophical question about what policy is, but also is a bit of a practical question about what we measure and how. And that's all we have for now, apart from a bunch of robustness.
Thank you very much. It was amazing presentation. Now we have some time for questions.
Yeah, thank you very much for the presentation. Can you say, have you looked at the effects from the different types of announcements, right? So you basically now just coupled everything into one category of monetary policy announcement. Have you looked, maybe there were different effects depending on what type of monetary policy effect there's been?
Yeah, that's an important point. We have not done yet that. First, because as an approach, we wanted to try to check whether one asset could capture them all. But now, of course, there's a bit of a sensitivity analysis to be done in terms of, is it that they all, in the end, for a given movement in copper, it's hard to define, you see, because effectively what you would ask is, for a given observed movement in copper, I should translate that into some scale on the use of tools, and sometimes the scales are very different. Mm-hmm. And then I should compare, the effectiveness of these tools. But the problem is that you miss that sort of scaling part. Let's say you change reserve requirements, and that translates in X basis point in the price of copper. How you do compare that with X basis point in the scale of copper due to interest rates?
Then it would be a nice sort of extension then to somehow equate the prices of different monetary policy tools through the price of a copper.
Yeah, ideally what you would like to have is some intermediate thing that tells you about the scaling, relative scaling. And then, I agree with you, there's an important question which we've been a bit struggling with, and is there a final grid on which we can assess the different tools, and we don't know. That's the fair answer. But thanks for...
Thank you.
That's an important question, I agree.
More questions? No questions from the audience so far. So I have a question. It's a little bit strange for me, the reaction of industrial production. It's very sharp on impact, which is usually you don't see in other countries. So how do you explain it? Very quick and sharp. I mean, this is something you wouldn't expect from the monetary policy.
Yes. So there's a large impact reaction and then kind of rebounds, and then which is slightly different from what we see, for example, on the longest sample, where it looks more like advanced economies when there's a price puzzle, output puzzle, with a kind of muted or slightly positive response on impact and then a slide. I don't have an answer. But I have the same question. And to me, it's probably due to the need of controlling for these information effects and potentially the different types of mix in the shocks between financial shocks, supply shocks, and demand shocks. And now these then are filtered through the decision of central bank, and they can give you different types of biases. If there are more supply shocks, I might give you one type of bias on inflation, one different on input, and vice versa, but we don't control for that. So in a sense, this is still a bit of a blurry picture of the effects, and we need to do a lot of work to make it sharper. And I take your encouragement for that.
Yeah, thanks a lot. It may make sense. I think it's a great job, and you have many ideas to go forward. Just a kind of a reflection. I also thought, did you try to check the tariff announcements? But that can be actually another paper on that. How to?
I agree with you, and no one could focus on some individual tariff announcement against China, because you want to potentially disentangle the big announcement against everyone and the entire world with respect to China. But yes, that's potentially a way to go, to look at commodity markets and how they react to.
Yeah, we have to try something similar for Ukraine, no? Unfortunately, we don't have that market, wheat market, maybe.
Ah, yeah, that's. Yeah, for China, for example, people sometimes mention pork market. We didn't push that far.
Okay, great. So if we have no questions, I don't see any questions from our online audience as well. So we had more than 70 people online today.
Well, thank you, everyone, both here and online.
Yeah. So thank you, Giovanni. Thank you, everyone, for coming. See you next time. Goodbye.
Thank you so much.
Much better than